Hello, good morning, everyone, and a very, very warm welcome to today's panel discussion, Perspectives on the Banking Turmoil. So over the next hour, we'll be discussing the causes and consequences of the recent bouts of financial instability that's hit the US and European banking systems. Now, I believe I'm joined, well, I can't see the person actually in the call, but we are joined by colleagues from the Talent Management Center at Qatar Central Bank, with whom we've jointly organized this webinar. So very warm welcome to them as well. Now, we have three outstanding speakers, I'm pleased to say, to help us make sense of these issues, who I'll now briefly introduce. Let me start with Alastair Ryan. Alastair is Head of European Banks with Bank of America, a role he's had since 2013. Prior to joining Bank of America, he had the same role with UBS from 2007, and he'd been a banks analyst there since 2001. So lots of experience with bank equity research. Next, we have Konstantinos Tsatsaronis. Kostas is currently on the board of directors of the Hellenic Financial Stability Fund. This is the fund that manages the Greek government's stake in 5 Greek banks. He's also an independent consultant. Prior to this, he worked for nearly 30 years at the Bank for International Settlements, the BIS, where he headed research and policy groups looking at different aspects of financial stability, including Basel III. And last but not least, Riccardo Rebonato. Riccardo is Professor of Finance at EDHEC Business School in Nice, I believe. Riccardo, I should have...
I'm in London, but yes, it's cool, yeah.
London, yeah. But in Nice. He's also the Scientific Director of the EDHEC Risk Climate Impact Institutes, and he's the author of a number of articles covering derivatives pricing, risk management, and asset allocation. And before becoming an academic, he had a number of roles in the financial sector, including global head of interest rates and FX research at the asset manager PIMCO. So a very, very warm welcome to all three of you, and thank you for giving up your time to kind of share your wisdom on these issues with us. Now, just before we kick things off, let me say that we're really keen to include Q&A from the audience in this session. So if you kind of look at the bottom of your screens, you'll see there's a Q&A box, which I imagine many of you are familiar with at this stage. So put your questions in there to the audience as we're going through, and I will convey those questions to the expert panel. So with that, let's kick off. Maybe we can start with a discussion of, let's try and kind of piece together what's actually happened, what's gone wrong and why. And Riccardo, I was hoping we could start with you, and let's start with Silicon Valley Bank. So what happened? Why did it fail? What's your take on this?
Okay, thank you. So why Silicon Valley Bank fell is relatively clear, and I'm going to come to that. But I think the real question is, can other banks fail in a similar way? So is this a canary in the coal mine issue? We are interested in Silicon Valley Bank, but only to a point. Our interests are wider. And there are some indications that perhaps we should worry. And one indicator that struck me is the change in the 3 month forward in 9 months. So if we look at like the third futures contract, 9 months out. And after the SVB, it fell by 100 basis points. So the expectation, we can talk a lot about the risk premium, convexity, all this stuff, but let's suppose it's all expectation. So by 100 basis points. And to put it in context, during the subprime crisis, the biggest fall was 50 basis points. Admittedly, there was consecutive falls in different days. So we add them up, but a single day fall is being much bigger than a subprime. Right? LTCM, you remember LTCM was 30 basis points. To find something for 100 basis points, we have to go back to Black Monday. So the market seems to be saying this is going to have big repercussions, because clearly there is an indicator of a monetary policy, and the monetary policy, we'll talk about that. So what could be the common denominator of things? Well, it's rising rates. So are these rising rates a source of vulnerability that could extend from the specific of Silicon Valley Bank to others? And in a very, very fundamental terms, is almost a tautology. But of course, if you think of a rate, you got your impatient bit, you got your plus, your risk aversion or substitution, whatever you want to call it, and then you have the growth in the economy. And therefore, if this rate were set in a free market, there would be the expectation of the market, but in reality, it is set by policymakers. So it serves the role of a hurdle rate. And this hurdle rate is not only for physical investment, but also for financial assets, financial investments. So if I put the hurdle higher, a certain asset that had expected cash flows all of a sudden doesn't clear the hurdle. The funding is no longer, and there is this dynamic, assets intrinsically fall in value with interest rates. It's nothing very deep. However, if we look at past crises, they all fell, these asset values, in different ways. If you look at, the obvious example is precursors to the 2008 crisis, to the 1997 Asian crisis, to the 1980s crisis, rising rates. But there is always something a bit different. In the 2008 crisis, it's true in 2005, 2006, we had rising rates. What created that was the end of a Ponzi scheme of the ever-increasing US property market. So the first thing that was affected was the US property market, and then given the distribution and leverage, it was all the securities, etc., etc. So there was lots of leverage. 97 financial crisis, increasing rates. The determining factor there was the huge current account deficit of the emerging market, dollar-linked, and a big exposure. Saving and loans crisis, I think it was very, very different. We don't have to go probably back to the 1980s. So, okay, can we find in this interest rate sensitivity something special about SVB? Yes. And something common? Perhaps no. Let's begin. Everybody knows extremely high share of uninsured depositors at SVB. The share of uninsured depositors was greater than 90%. And if there is the IMF has created a nice graph in which you put on the one axis the share of uninsured depositors, and on the other axis the impact of the mark-to-market losses on their common equity tier 1 capital. And in their case is 12%. And SVB was an outlier for both, for share of uninsured and for the loss to common tier 1. 12% for SVB. For most banks, it's around 2-3%. For no other bank is greater than 5%. So really an outlier. From this point of view, it's something special. To give another example of this, only one bank with assets greater than 500 billion. 500 billion is the threshold of the IMF to define a large bank and a small bank. So only one bank, big bank, has a share of an uninsured deposits greater than 75%. The bulk of the biggest are around 50% area. With one exception, all the banks with share of uninsured deposits that are greater than 50% are small banks. So it's a relatively small bank problem. Another thing which I think was quite unique about SVB was the deposit growth. SVB was the fastest growing bank, and by the way, Signature Bank was the fourth fastest. The growth rate from 2018 to 2022 of deposit base was 4 times as large as the fastest growing global systemic bank. In a way, it's not surprising because when you're a big bank, it's difficult, but it's still 4 times is. And the other thing which is interesting, 15 fastest growing banks are all non-globally systemic banks. So the thing that comes out from this is there is something very special about SVB, and the common features tend to be shared by non-systemically important banks, by the aggressive growth banks. Now, here there is something that has puzzled me, and perhaps I'm barking up the wrong tree, but there is something I would like to share with you in my reasoning. Let's simplify the balance sheet of SVB. I know that they were also holding venture capital, but let's forget about venture. Let's focus on the treasury. Everybody's been looking at the treasury report. Now, the treasury holding is, in old banking terms, money good almost by definition. So suppose that instead of lending to the US treasuries, SVB had lent his money to very good corporates, very high quality corporates. Not on the trading book, it would have been on the banking book. All these assets would have been money good. Yes, interest rates have gone up, but there would be no increase in delinquency because we have lent to very, very, very good corporates. Now, from that point of view, what has happened to the SVB would have been a liquidity and not a solvency crisis, because on the asset side of the balance sheet, the value of their loans would have remained unimpaired. And therefore, would probably, and I'm speculating here, have had more easy access to funding liquidity from a central bank, perhaps at punitive rates. But now it is a bit funny that because it lent to the US Treasury instead of to corporates, it found itself in a more difficult position. And clearly, it's all due to the fact that in one case, you're on the trading book, which is mark to market. So your losses are crystallized immediately, and it becomes a solvency crisis, which draws my attention to an observation that I've made many times of the dangers of the siren calls of the mark to market in good market conditions. In good market conditions, banks are always happy to put stuff on the mark to market, telling regulators, this stuff is super liquid, look, it really, we have price visibility, etc. When things turn sour, and we saw that in spades in 2008, having parked securities on the trading book becomes problematic, which I think is something of relevance in this context. And the last thing, I've seen a very nice graph between the movement in price of the SVB bank and the sentiment analysis between positive and negative news on Twitter of SVB tweets. And the correlation is very, very high. Now, from the point of view of an econometrician, they will make a field day to study Granger causality, which one came first, were tweets negative because the price was going down, or was the price going down because, etc., etc. However, there are some considerations which are, I think, interesting and perhaps spill over from the case of SVB. For SVB, and by the way, also for Signature Bank, 30% of their depositors were crypto depositors. These are well-informed, tech-savvy investors. So it's a tech-savvy investor base. Therefore, one might think that they are particularly quick, nimble, reactive, and therefore particularly skitty. Retail depositors are supposed to be slower and stodgier. However, I question whether we can rely going forward, given the ubiquity of tweets, and we don't have to discuss what's happening also in the political arena with tweets, etc. So perhaps the assumption that we make that your regular retail depositor is going to be relatively slow moving and things can be handled in a graceful manner is not to be taken for granted. Can we rely on the retail investors remaining stodgy? Do they still act as ballast? It's not obvious to me. And this could be something that gives an element of worry. So my message, and I'll conclude now, is there are some, to me, very specific things to SVB, and even more so Signature Bank, which is much smaller. It's about 100 billion in assets to a relatively small bank, and not directly transferable to the banking system as a whole. Clearly, in the period of high rising rates, yes, everybody is under more stress. However, I would put my money on this not being a systemic and more, I wouldn't say idiosyncratic, but more specific, more circumscribed crisis. This, I hope, they are not going to be the last famous last word, and then this is going to be played over and over on a tweet, look what Riccardo said in mid-April. But this is my view at the moment, based on this analysis. Now, Alastair and Kostas will tell us if they agree or disagree, or they have a different perspective. Thank you.
Thank you very much, Riccardo. It was a very full, complete answer. So I want to turn to Kostas next. So firstly, feel free to react to anything you heard there, particularly if you agree with it, it's all fine. If there's anything you disagree with, do jump in. Let's leave the discussion to kind of whether this is systemic. Let's come back to that at the end. So let's focus a little bit on SVB in particular. Yeah. The particular question I want to ask you, Kostas, is the role of the regulators. We've actually had a question in the Q&A on this. So, you know, is this something they should have spotted? Is it a regulatory supervisory failure? Over to you.
Okay, well, thank you. Now, I agree with many things that Riccardo said. I will differ a little bit on some. I treat this Silicon Valley Bank case as a textbook case of a bank failure. It just failed in the narrowest sense of banking, in sort of misjudging the risk between borrowing short and lending long. That is the transformation that banks do. That is what people teach students, that's what banks do, first class. So they misjudge this risk. Is this idiosyncratic or systematic? We'll get to that, but let's put it like, so there's individual decisions that they taken and they were exposed by a macro situation, rising interest rates. So there's not like a purely idiosyncratic thing. Very few bank failures are purely idiosyncratic. I had to go back to Barings last century to kind of spot a purely idiosyncratic case. So there's a failure of risk management, it's clear, and it is a textbook, ex post is a textbook case. I mean, how can you miss this? It's a legitimate question. It wasn't hedged, and it was misjudged the flightness of the deposits. They were both the rates, which tend to be sticky. Actually, deposit rates are stickier in the beginning of the tightening cycle than later on, but they're always stickier than the underlying policy rates. And again, on the quantities, that is what Riccardo said. Like, these are big, sophisticated players. You shouldn't expect them to behave like myself and my aunt. We're kind of have the money in the bank and they just kind of watch the things happen and do nothing. So the problem was a liquidity crisis. Here's where I'm gonna disagree a little bit with Riccardo. Actually, the asset side of this trade, treasuries, were not marked to market. They were actually held to maturity. They were kind of accounted on book value. Okay. And that was the problem, actually, because when they sold, they had to sell them for liquidity. Okay. They realized the losses that they had not realized before. So a big dollop of losses popped up overnight, and that's a big hole to cover. So we're gonna get later on, I hope, on regulatory treatment of these things, because that's a little bit of interesting thing. Now, before we go to the regulator, look at the supervisor. Why did the supervisor miss it? Well, technically they didn't miss it. I understand that there have been warnings given, they just were not loud enough. Was it the largest of the smaller banks, therefore they could kind of get away with it? Probably. It was sort of like too large to be small and indifferent to from a systemic perspective, but not large enough to be part of the large bank supervision regime, which has more stress tests. presumably has more opportunities for the supervisor to do things or voice things in a more loud way. But at the end of the day, I'm not of the BIS, so I think the supervisor cannot be blameless in all of this, business. And I do think that it is an illustration of a situation where which I kind of sensed a lot during my times in dealing with banks and supervisors from a distance, is that the supervisor is expecting the bank to do the good thing from self-interest perspective. At the end of the day, if it's not written in the regulation, then it's not done. And sort of this is bizarre from the outside, but this is what happens. And unfortunately, there's an illustration of that. So I'll stop here with this little kind of correction, or from my part, disagreement from my part on Riccardo's thing. But then I think that both the bank failed to do the basic thing, and the supervisor failed to spot the light on them or put the light on high enough intensity.
Thank you very much, Kostas. Very interesting. All right, let's turn to Alastair. So Alastair, same question, if you disagree with anything on that would be very interesting to hear in terms of what the previous panelists have both said. I guess my specific question for you is, can you give us a sense of how widespread these issues are within the US banking system? There's actually a question in the chat already from Martin Wheel, one of my colleagues at King's, who asks, is the whole US banking system capital deficient at current market prices? So maybe you want to react to that as well. Over to you.
Yeah, thanks, and good morning. So that taking a step back, so I'm obsessed by the Bloomberg screen. I deal with market prices every 30 seconds, so it's less natural for me to say take a step back. But what is it that you want banks to do, and why has every economic system, from China through the Soviet Union through everywhere, why has everywhere come up with fractional banking, with commercial banks intermediating between overnight deposits and term investments, either term lending to companies, to people, or to governments? So if you want to be able to take a mortgage in the UK at 0.7% above the cost of money for 30 years, if you want to do that, you want a commercial banking system. Now, you want that as people. Companies want to borrow at 1.1%. People want to borrow at 0.7%. Governments want to be able to take duration in their debt. Now, if you want those things and you want to fund it through overnight money because people want liquidity in their money, which you do, you don't want to tie your money up for 15 or 20 or 30 years, you're going to have commercial banks. Right, so we've established that. And therefore, we've got all sorts of duration, liquidity, mismatch, capital, funding, credit, trading risks embedded in the system. I'm really keen that in this conversation, we start from that principle, because otherwise what we're doing, what Martin's question leads to, is we're trying to drive out risk. Fine, you can drive out risk all you want, but that will create economic inefficiency, or it will create risk elsewhere on central bank balance sheets, on non-bank financial balance sheets, in your pension fund, as the UK learnt at incredible cost in late 2022. It will come up somewhere else. So if you don't want the risk, fine, you can't have a mortgage. I'm sorry. Many people on this call probably is somewhat distant in the future, but people in general want that. Companies want money and governments want to be able to borrow cheaply, right? So what do you got? You got a commercial banking system. So what we're balancing is risk and reward for society. Given that, you've got a commercial banking system which is less risky today than for 50 years. You've got less trading risk, less liquidity, less funding risk, less capital risk, less risk broadly defined in your banks than you've had for at least half a century. So your starting point is, are you sure you want less? You might want more, because what happened here is three banks which stood out, as Riccardo and Kostas have rightly highlighted, three US banks which stood out as being very rapid growers, very specialist, very different to the average bank, which were regulated less tightly than the big banks, did things which less regulated companies often do. And so you've found that there's a regulatory gap in the US, which has been taken advantage of by companies that have found themselves troubled. In Europe, the Credit Suisse experience was a company that had been in all sorts of trouble for many years, was trying to get round the corner and actually implement a strategy that was potentially more robust, that was well capitalized and incredibly liquid, company that was actually able to absorb a bank run in the fourth quarter of nearly 30% of its deposits. In the end, just lost the confidence of the people that it needed to be confident, counterparties broadly defined. And that was a combination of external events, specific comments by specific shareholders at bad times, but also, years of poor decisions by the company, poor execution, control issues, and so on. So anyway, in the end, it was a little bit, how did you go bankrupt, sir? Slowly at first, then faster and faster, right? and they weren't bankrupt; they've become part of UBS. But there was an element of that kind of experience, right? That this is something that had built up for a long time. And in a way, it's a shame that the people in the seats at the very end were the ones finally trying to fix it. They just started too late and didn't have the resources to do it. But I'd really make that point. And actually, central bank, to the other question in the box, central bank digital currencies are absolutely not. They're the worst possible solution to this. A terrible idea from this perspective. Just to illustrate the complexity. So the one bank, I know it was Riccardo that mentioned it, the one bank that had the bad in inverted commas insured deposits to total deposits ratio of the of the 500 billion, actually it was you, Kostas, 500 billion plus, is HSBC. I'll tell you who that is. It's HSBC. And I'll also tell you they've got the best deposit base of any major bank. So that's what every metric is a fascinating thing, because that was exactly the right metric to look at for SVB. Absolutely. And it's exactly the wrong one to look at HSBC. They've built their bank over 160 years to be the sort of bank that people take money to in a crisis, uninsured or not. You just know HSBC is the way you put your money in the economies that they operate in. They're the essential bank for their corporate clients, so that they don't have big corporate deposits that are flighty. They have big corporate deposits. They're very sticky because they're the operating account. They're the trade bank. They're the essential payments bank for those companies. So sometimes a metric will point you in the right direction, Silicon Valley Bank. Sometimes it'll put you in the wrong direction, HSBC. We've got to use all of these metrics with care. I think the key is that regulation has required a massive de-risking of the banking system. That what we specifically took in 2008 was a banking system which had one constraint, a Basel II, as it was, or Basel 1.5. We were halfway through it. Capital requirement. And we've turned the system now into one that has a much tighter capital requirement, but also a leverage, a funding, a liquidity, stress testing, multiple fronts, each of which reduces risk. And in the round, the banking system, as a result, has little duration, liquidity, funding, capital, trading, credit risk. And so the learning for me is that banks that were somehow not subject to that, which are the specific US banks in question, or banks that were just not good enough in the end as a standalone company, or ran out of time to convince you, are always going to be featured. So it's the idiosyncrasies of those banks rather than the learnings for the system as a whole. And you will not squeeze risk out of the banking system without either A, hobbling the economy, or B, just disappearing the risks into, let's say, pension funds in the UK, which then implode the gilt market in one afternoon. To be clear, if you look at the Bank of England's conclusions, it happened on the day of Kwasi Kwarteng's budget that the LDI ran out of money. Same day. I'd take the banking system over that risk.
Fantastic. Okay, so we've had actually three quite different perspectives there. Riccardo, go.
Very briefly, I agree with Alastair, and thank you, Kostas, for the pointing out. I think it wasn't available for sale. I would, but let's keep my comments focused. Alastair said, perhaps banks should be taking more risk. And the question is, what type of risk? One aspect which I think has been rather unfortunate in the last regulatory round, many things were well thought and I think necessary, but it's been the coming down like a ton of bricks on proprietary trading, which has created an impaired liquidity. And here I have a very small anecdote. I spoke with a senior central bank that I will not name, and that was in the aftermath of the 2008 crisis, and I was showing, or came with all my papers and graphs, etc., saying, look, proprietary trading really has done almost nothing to the losses that we have experienced. And this central banker, that as will remain unnamed, said, look, when a fight breaks up at the pub, you don't punch the guy who started the fight, you punch the guy you always wanted to punch. And that is what we're doing at the moment. So there is, from a central bank point of view, a great unease in saying, on the one hand, there is a depositor's insurance, and then these guys go out and do bets. That logically, it doesn't sit very prettily, but I do think that the clamping down on proprietary trading is the one element in which the cost-benefit analysis has not been appropriate. And we have seen many instances where impaired liquidity of traders has created hiccups. So I wouldn't open the spigots of risk for banks indiscriminately, but in that area, I think it would be a good idea. I don't know if Alastair agrees on that.
Kostas.
The three-word comment to this is fine, but liabilities have to become much more risky in order to hope that there's going to be enough discipline and kind of and what happened is the response to this events right now, actually, especially in the US, it just de-risked the liabilities a lot in order to quell the fire, therefore creating insurance for depositors that it wasn't there, creating backstops for banks and so on and so forth. So it cuts both ways, Riccardo, what you just said, in my view. I don't disagree with somebody has to take the risk, and risk is actually a good thing at times, but it cannot be without more risky liabilities of banks.
I think this is a nice segue. One thing I wanted to touch on was the policy responses we've seen, which have been quite, say, controversial and dramatic. One specific area that's received a lot of attention was around the Credit Suisse decision to write down AT1 or additional Tier 1 bonds. I think maybe Kostas, you could lead on this. Perhaps you could kind of explain to the audience what these additional Tier 1 bonds actually are, and why was this a controversial decision by the Swiss authorities to act as they did? Right.
Yeah. I think Alastair did a good job in actually characterizing Credit Suisse problem, which is a chronic culture kind of problem of the institution. I do remember that in 2008, UBS got in trouble because they tried to imitate Credit Suisse and they did it too late, actually. Anyway, so I think that the Credit Suisse episode is intellectually more interesting, at least to an observer like me. It's like a GSIB failure. I'm just going to be very blunt with the characterizations. In a country with a strong supervisory culture, it just happened with very quickly. Yes, it was withdrawals for a long time of assets under management, not deposits, assets of clients. But it just happened kind of over the weekend. And at the time where regulatory ratios were just way above minimum. Capital, liquidity, everything just looked fine. In a country with good supervisory culture, I repeat. So it's not a textbook case of like things eating up gradually into capital. It just, it's very special. And from this perspective, that it required special intervention by the authorities. Now, the most controversial part was, as you said, David, the fact that a bond, a perpetual bond called, of the additional tier 1 flavor, was wiped out before wiping out equity holders. Okay, so there were like 16 billions of bonds that they were wrote down to zero, and there was 3 billion of equity that was left over after UBS took over the bank. Now, what are those things? Think about, capital in sort of running from tier 1 to tier 2. Tier 1 is something that it's called going concern type of loss absorbency, meaning it is there so you can actually buffet shocks while you have an ongoing business. Tier 2 is used when you're kind of clinically dead, to make sure that, things don't, liabilities are paid on time. So tier 1 starts with equity, and this is sort of the first port of call. And then it's followed by additional instruments, additional tier 1 instruments, which are those perpetual bonds. They don't have a maturity, they have to be perpetual, and they come in different flavors in how they absorb losses, and there are various combinations of them. There's not just one thing. So they absorb losses because coupons can be skipped, because they can be converted into equity, because they can be written down, like what happened in Credit Suisse. They were written down. Some of those flavors exist in every bond. Some bonds have only some of those flavors, but that's one dimension, how they're written down, of how they're absorbing loss. And second is, when do they absorb loss? And these are the trigger events. And there are trigger events that depend on capital ratios. Like for Credit Suisse, there was 7% CET. So if it falls before CET, if CET falls below 7%, then this is a trigger event. Or there can be a viability event, which was what the authorities called here, because the bank was not viable. We can write them down. So there are all sorts of combinations and flavors on these things, and so on. Tier 2 is something different. It is more like a bond. It can have a finite maturity and so on, and it is sort of now. Mind you, tier 1 and tier 2 things count as capital. At the same time, all of the above and some other stuff count for the TLAC for GSIBs, was sort of like additional loss absorbency stuff and all sorts of fancy stuff. The TLAC is called MREL in Europe, by the way. All right, so what happened is the textbook case says you start eating from equity and then continue the hierarchy. And so on, and you do this in a gradual way because things do not happen overnight. Well, that was not the case here. So things did happen overnight. The bank closed Friday night with a positive equity of 1.85 Swiss francs to the share. And people woke up on Monday morning with the bank sort of being absorbed at less than half of that price by UBS. Now, at the same time, as I said, the UBS paid a positive price of, I think, 75 cents to the Swiss franc, to 75 cents per share, and total of 3 billion, while at the same time 16 billion of AT1 was wiped out. So people up in arms, equity is still positive. How can we lose the bond? Was it legal? Yes, it was legal. There's no doubt about it. If you read the not so fine print on the documents of the bonds, it was possible. There was nothing weird about it in the prospectus. Was it surprising? Yes, it just kind of upends the usual what you expect to happen. Other explanations, well, fine. Yes, it was a hard thing to do over the weekend, and it needed to be done very fast. Needed to be done with minimum disruption. Credit Suisse was not SVB; it's just a much bigger, much more connected animal. You have a downside protection that was offered by the state first to Credit Suisse and then to UBS, and therefore that kind of makes more eligible interventions such as writing off the AT1. And there was another thing that a major shareholder of Credit Suisse was a sovereign fund. And there was a little bit of a political risk had that been written down to exact zero. It would sound like nationalization. And I think there was a fear that can trigger legal kind of challenges that they didn't want to get into. There are going to be lots of implications. Maybe we can discuss later about that, but sort of this is what happened then. And it is, for me, that's a much more interesting story to kind of think through, both the nature of the failure and the intervention.
Yeah, it's very interesting indeed. Alastair, turning to you. So can you give us a sense of, like, I mean, Kostas mentioned the implications of it. So what does this mean for the market for these bonds? So, you know, a lot of banks do issue these bonds. Are they going to continue to want to do that in future? Will the cost just be higher? What's your take?
Thank you. So again, taking a step back, so equity's expensive, right? Shareholders have demonstrably a need to see a bank making 10, 12, 13% a year on its equity in order to be willing to allow that bank to carry on in business, to lend to the economy, to grow, to make normal decisions. Right? That's an observable figure. At the moment, it's more like 16% you can back out of share prices, but we're in a period of stress. You'd perhaps that. So let's say your bank needs to make 12 or 13% on its equity to be in the game. So if you want the bank to have more equity, to remunerate that, so European banks are sat on a couple of $1 trillion of equity. So if you wanted a more strongly capitalized bank, well, you know, let's say you need another $1 trillion, well, you're going to need to let banks make another 130 billion a year in profit. Shareholder expectations don't keep coming down. Modigliani and Miller proved not to be robust in the end. That's a bit of conversation David and I had many years ago. So one of the things that regulators came up with was shades of capital. As Kostas was saying, there was always this idea of tier 1 capital. And there's now also this idea of TLAC MREL, some kind of senior bond that one day the regulator can tell you wasn't a senior bond at all, has been wiped out. The way of thinking about these are securities which have options for regulators embedded in them, as in the market's written that option. So effectively, the sort of tail risk insurance that's provided by capital beyond very high capital levels in banks is provided by the market, when it used to be provided largely by taxpayers. So in the event that a bank burned through its capital substantially, the bank could burn through its equity and the taxpayer was on the hook. And in 2008, that tail risk materialized in a lot of countries, absolutely here in the UK, and taxpayers were quite annoyed about it. And so as well as more than doubling equity capital requirements, in fact, the Bank of England considered them to have tripled, there was also a massive expansion in these other tail risk insurance forms of capital. Now, that seemed very appealing in a lot of ways to regulators, to governments, as ways of improving the capitalization of the system under stress. But options are volatile things, right? I mean, I'm sure talking to specialists in finance, options, you know, the value changes a lot and people's willingness to write them changes a lot. And what happened demonstrably at Credit Suisse is the market changed its consideration of the likelihood of the option of write-off being applied to AT1, but also to the Tier 2 and the MREL, which is not even called MREL in Switzerland, it's called bail-in debt, but same kind of stuff. And what happened there was the price of those things collapsed. And actually the mechanism of the crisis at Credit Suisse, so the reasons for the crisis go back many years. Kostas was taken back even further than I would have done, back into pre-2008. But, you know, they go back a long way. But the mechanism of collapse was the price of the bail-in debt, not even the AT1 debt, collapsed from about 95 cents on the Monday of the week to low 60s by the Friday. The credit default swaps of banks now reference these bail-in securities, and so the CDS blew out and counterparties left the bank. So actually, while distancing the taxpayer in theory from the event, in practice, those bonds got paid, so they didn't perform that, and they created a mechanism for a crisis in California to translate into a bank event in Switzerland. So they're potentially very dangerous, those bonds. They're not providing safety at all. That actually society would be much better off underwriting that tail risk insurance itself rather than having the market do it, because the market's demonstrated once again it's not able to do things like that with very complex, very risky securities as those prove to be. Things that sublime, 1 minute they're worth par and the next minute they're worth nothing because they've been written off. The market can't price those in a crisis. It just sells them, and the selling creates the event. So what I'd say is we're always at any moment in time, we're always working on the basis that the people who constructed this structure had missed something important that we now know. And actually, I don't think that's the case. I think the whole TLAC MREL structure wasn't invented before because it doesn't work well. So if you've got a banking system that's well capitalized and is constrained against liquidity, funding, stress testing, as well as exclusion from like Riccardo said, from proprietary trading, this reinsurance you bought on top is probably quite expensive. So again, the conclusion from the episode so far should not be that banks need more capital. It might be that excluding certain banks from certain requirements will always create a wall over which things are done differently on the other side, possibly less well. But you know, creating more of these instruments or putting them out there might be wholly counterproductive.
Very, very interesting. Food for thought. Why don't we use that as a segue to like a broader question that I'll ask, you know, you can all, each of you opine on, which is kind of like whether, does this episode tell us anything about how the Basel rules that we designed after the 2008 crisis, how these are working? I mean, I initially framed this question in my mind as, was it the case that these rules just weren't applied very well in the case of SVB Bank in particular? But we could take this as a broader question about whether there are, you know, Kostas and Riccardo, you might want to react to the comments Alastair just gave about AT1 and the role it has in the capital structure, or take this in any way you like. Who would like to kick off?
David, let me kick off briefly, and then they've got more to respond to.
Sounds good.
So the rules that apply to banks today are broader than Basel came up with. So stress testing wasn't in the Basel rules, is a very binding constraint for many banks. TLAC wasn't in the Basel rules at all either, right? So there's been some inventions beyond that, but broadly, Basel has, the current structure has required banks to have a lot more capital, a lot more liquidity, a lot more funding, and to consider risk on a gross basis with a leverage ratio, and that is effective. You will never be able to legislate out bad outcomes. You shouldn't try. You take too much risk out of the economy. You take too much duration provision and credit risk provision out of the economy. So you can never avoid a Credit Suisse in the end without simply intervening in the company earlier on. I think in the US, it is really important that the three banks that failed were not subject to the same rules as the big banks. And so that regulatory wall a drawing of that regulatory wall has not proved to be robust.
Riccardo.
Can I make a small point? I agree with everything you said, Alastair. You started saying investors require, let's call it a 12% return on equity for banking stocks. The academic argument was going to be a bit different. Says, well, if we make you hold more capital, the bank becomes safer, and therefore the investor no longer requires a 12% because it's, oh, now the bank is safer, therefore I'm happy with 6% return. It is the you can call it stochastic discount factor, you can call it risk reward return, but it's the same thing. Now the question is, does automatically in this new world putting more capital make the bank that much safer? And are there other sources of vulnerability for a bank which are not covered by the blanket of the capital? Because then everything breaks down. The big idea was, no, the investors will be happy with the higher capital. They will just say, this thing is dodgier, is safer, so I don't need 12% return, I'll be happy with 6 or 8. But if then the capital is not perceived to be as risk insulating as it was thought to be, then that's the problem comes in.
Kostas.
Yeah, actually, that I like the way Riccardo put it. I cannot fully agree or disagree because this is something I cannot, just give you a condensed sentence where here's my suggestion. I think I agree with Alastair's point that fancy stuff prove that they're not working. That's why I like the Credit Suisse as a study case, because sort of the fancy stuff just kind of became irrelevant, completely irrelevant. Sort of we're talking about AT1 because they just popped up in newspaper articles, but sort of at the end of the day, were irrelevant. Unfortunately, what was also irrelevant were sort of regulatory capital numbers that they were proven to be totally insufficient while being way above minimum.
Yeah.
So that it goes to Renato's point, sort of is capital safety? Do you need more capital to actually get the safety? And that is where I stop, and I like that question, because at the same time, like you say, like, yeah, I agree with the point that, if it is safety, they will require less of a premium in terms of like cost of capital, but at the same, but if it is not safety, then how much do you need? And the more you have, the less capacity to do business you have. I mean, that is the other side of it. The business benefit goes down. Now, but that is the true question. And going back to what I said, that unfortunately, being in a situation where if it's not in the regulatory book, it just doesn't happen in terms of like risk management or buffers or what have you, then it's a difficult situation for the prudential authorities to sort of like put a magic number there that balances all of the above in a diverse set of people. But I totally agree that the fancy things are not as good as most people thought, or when they were put on the table. Actually, a slight correction, TLAC is a Basel thing because the FSB is also in the same tower as the Basel Committee. So that was a joke.
Sorry. All right, we're almost out of time, and I do want to ask one final question to you, and then my colleague, a colleague from Qatar Central Bank has joined, and we'll say some brief end remarks. So my last question, and you'll have to be brief, I think, and I'll ask it. So Riccardo's already given his take at the outset about whether this is likely to kind of rumble on or whether this is an isolated problem. Kostas and Alastair, could you both give us your sense of this, and then Riccardo, I'll give you a chance to react if you like.
Yeah, very briefly. So that the US authorities have already indicated that the exemption of banks between 100 and $250 billion of assets from the rules that apply to the big banks is going to end. And that's a really big shift for those banks, that they'll find that many of the things that they thought they were good at doing, actually they were doing a lot of because they were more appealing under their regulation than the regulation that applied to the big banks, right? They weren't necessarily a better real estate lender. They just needed less stress capital or less funding or less liquidity against the loan than the big banks did. So that is a business model challenge for those banks. That is a credit supply challenge to the US. That is years of deleveraging and profitability, hard work for those banks. So that is real and long lasting. For the big companies, I'd say they feel reassured, right? We've just had another, dump of external events to which the banks have proved robust, and I think that's reassuring.
Yeah, my very quick take is banks are in better shape now than they were before, and I wouldn't look at sort of little idiosyncratic stories as before. This is sort of what should worry us is macro tides lifting or sinking boats together. From this point of view, I would consider interest rate risk, the SVB type, as being not a non-event, but as something, okay, we woke up, we saw it. If it's anywhere, it is being dealt with right now. So that's not where I would look at. But there is a turn of the financial cycle, the credit cycle. There is, high debt levels everywhere, from governments to households to companies. Debt servicing costs are going up. Commercial real estate sounds something like something will drop from that tree. I don't know when and how, but these are more traditional asset quality type things combined with leverage. That is like the classic case of problems, and that is how I will be looking at where they're going to be trouble. From that angle, not the SVB type situation.
Thank you very much. Riccardo, last word for you. Is there anything you'd like to?
Yeah, very briefly, I fully agree with what Kostas and Alastair said. I would just make a last comment, if I may. It is good that the rules that are applied in these situations are written with a certain degree, what I would call constructive ambiguity, so that the regulator is not completely and totally boxed in extremis. To some extent, it is obviously good. And Guyton has referred to use like the Old Testament attitude, so vengeance and punishment. No, that we have to get over that. In extremis, flexibility and pragmatism is good. The fact that the rules are written in such a way that there is possibility of interpretation. However, if taken too far, this can create the expectations that the rules will be interpreted in a particular way. To give you an example, in 2008, before 2008, the mantra, which happened to be correct, was Fannie Mae and Freddie Mae cannot fail. It was not written in the rules, but that was the expectation. This is dangerous because it's a tiny bit, what comes to my mind is like a game of chicken in the James Dean movie. So who is going to supposed to swerve first? So to the extent, it is good to have a flexibility, but at the same time, this flexibility creates expectations that the flexibility will be exercised in a particular way. And if it is not, then there can be a crash. There is no easy solution there. But not having the flexibility would be even worse. But let's not think that having it is all, in game theory terms, this is it cheap talk or is there a strategy of commitment? It's very difficult to find a strategy of commitment that says you have to put your money where the mouth is. And therefore it becomes this James Dean game that in the movie did not end very well.
Very good. Okay, let me hand to Ruda if you're there. You're currently muted, so if you unmute yourself and give us your final remark.
Yes, hi everyone, and thank you for joining this webinar. As David said, my name is Roda Naima, and I'm representing Qatar Central Bank on the behalf of Wadh Al Jaber, the Director of the Talent Management Sector. So thank you, David, for facilitating today's discussion, and thank you to our panelists. We hope that you found this beneficial, and in case you have any questions, please don't hesitate to contact us.
Excellent. Well, big thank you from me to Alastair, Riccardo and Kostas, and join us again for another one of these discussions. Thank you very much.
Thank you. Thank you very much.
Thank you very much.